Hi, everybody. We are going to get started. Welcome to Lunch and Learn with Melinda. That would be me. I am the owner of The Truth About Lending. For those who are joining us for the first time, welcome, welcome, welcome. And for those who are returning to our webinar series, we are happy that you're back. We do this every Wednesday. We talk about a different topic every Wednesday from 12 to 1. And we're really trying to educate our community, our real estate community, and answer any questions, keep you guys updated on the pulse of the mortgage industry, what's changing, what's new, and how we can all work together as a team to try to continue to promote home ownership and the creation of generational wealth through home ownership. So welcome to our Lunch and Learn. This week, we are talking about condo financing, which has always been a difficult problem in Florida with Florida condos. It has progressively gotten more challenging over the years, and we're going to talk a little bit about why and how to work within the condo financing arenas as far as what you can do as an agent to better service your client, to better protect your client, and to understand when you're taking a listing or when you're working with a buyer, when it comes to condos in Florida, what can be done and how to best service your clients. Because this is a pretty complex topic, I encourage you to put any questions in the chat box as we move along. I anticipate that there'll be a lot of stuff that we're going to cover. So please, if you have any questions at all, as we move along, put them in the chat box because there is a lot of information we're going to cover on condos. So anybody who is a realtor in Florida knows that there's a problem with financing with condos. Why has that happened? And what is the history on that? We're just going to spend one quick minute talking about it. So in 2008, when real estate had a big crash, especially in Florida, condos actually went down quicker than single family homes, primarily because of the people that were managing the condos ended up having a lot of problems financially because of the homeowners that were in the building not being able to make their association dues or pay their association dues. And so a lot of condos ended up in receivership. And so the decline in condos was a greater decline than with single family homes. And the entities like Fannie Mae and Freddie Mac and FHA all saw that and said, wait a minute, because of the concentration of condos in Florida, we're going to make a different rule for the state of Florida than there is for the 49 other states. Like, yes, we are still under many of these rules. And so what's important to know when you're working with a mortgage professional, especially if your clients are working with a mortgage professional that is not familiar with Florida and condos, definitely a big red flag, because there's a lot of nuances that out-of-state loan officers or call centers or companies that are not local to the state of Florida do not know how to work within. So things were starting to get better, and they were starting to have some loosening up and a little bit of ease in some of the restrictions. And then we all know what happened with Surfside in 2021. And so that then changed things and made things a little bit more difficult when it comes to condos. So what changed in 2021 was that Fannie Mae decided that they were going to do an addendum or an additional document page on the condo questionnaire, regardless of the down payment. So I know a lot of agents out there are thinking, well, if somebody has 25% down, this is like the magic number to be able to buy a condo with much more ease. And so some of this stuff doesn't matter. Well, that's actually not 100% accurate. The new form that Fannie Mae and Freddie Mac put into place is an addendum regarding assessments. And some associations are willing to answer these questions and some are not. It's not just about assessments. It also asks questions like, are you aware of any structural work that needs to be done in the property? Or are you aware of anything that's unsafe in the property? Or are you aware of deferred maintenance or some type of maintenance that needs to be done in the property? Now, some associations will say, sorry, we're not going to answer that per our legal advice or our attorney, our counsel, we're not allowed to answer that. Some will answer it, some will not, and give us copies of their minutes. There's a few ways around that, but we're going to kind of talk through the entire process of what does that mean and how things have changed as a result of that. And a lot of agents out there think that if there is an assessment on a condo and the seller is paying for the assessment, that you don't have to worry about it because the assessment will be paid in full. Actually, that's not really the case at all, because when there's an assessment on a condo, if the buyer is assuming the assessment, okay, then we count it in the buyer's debt to income ratio. But if there's an assessment on a condo and the seller is covering the entire cost of it, we still have to address why there was an assessment, what happened with the building, and what is the status of the assessment. So we're going to talk a little bit further about that as we progress through this webinar, but just because a seller is paying for an assessment does not mean that everything is wonderful and great and we don't have to pay attention to the fact that an assessment happened. So let's first talk about when a condo is approved and when it's not approved. Sometimes you'll hear the word warrantable or non-warrantable. Those are words that are used interchangeably when it references condos. A warrantable condo means it's either approved with Fannie Mae or has the ability to be approved with Fannie Mae. Now, it's not just Fannie Mae. And when I say Fannie Mae, I mean any conventional loans. As a reminder, pardon me, as a reminder, conventional loans can either be Fannie Mae or Freddie Mac loans. And I think I've talked about this in the past. It's like saying hamburgers or McDonald's hamburgers, there's Burger King hamburgers, they're still hamburgers. So it's pretty much the same thing. Conventional loans can be Fannie Mae or Freddie Mac. The reason why that's important to know is that there's a slightly different guideline when it comes to condos with both of them. And sometimes that helps us and sometimes that hurts us. So it just depends. And you really need to be working with a loan officer who fully understands those differences. Because if you're working with a loan officer who does not understand the nuances and the differences between the condo requirements with a Fannie Mae loan versus a Freddie Mac loan, then you may have a denial of a loan with a condo for Fannie Mae that could have potentially worked with a Freddie Mac loan, but your loan officer didn't have the education or the experience to know, hey, wait a minute, let me try this other route. So that's where we come in. We really are experts in this particular subject. We're experts in a lot of things, but especially condo financing. So let's just talk about how can we tell if a condo has been approved or previously approved or will be approved, and what is looked at and what is the process from there. So first of all, there's something called the CPM, stands for the Condo Condo Project Management System. This is like the database where all conventional condos are listed that are either approved or not approved, except that Fannie Mae, Freddie Mac, they don't technically issue an approval on a condo. They make it either available or unavailable. Why they do that? Well, they've got a screwy way of thinking that they're not actually loaning the money. So it's not up to them to approve or deny a condo. They'll only make it available or unavailable. So what do the lenders think? The lenders look at it like, if it's unavailable, that means it's pretty much the kiss of death when it comes to condos with conventional loans. They are looking at it from the perspective of this condo was rejected by Fannie Mae for a particular reason, and whatever the reason is usually listed in that system, and they don't want to touch it. If it's available, it means that it was approved at one point and it can get financing, but it doesn't negate the fact that there are still some questions that have to be updated, such as, is there any new lawsuits? Do they still have accurate insurance, enough insurance, all these other things. So just because it's on this approved system doesn't necessarily mean it's a slam dunk. Just like if it's on the system as unavailable, there are other types of financing that our portfolio lenders, which we're going to talk about here in a minute, that can be used to still get financing in the building, depending upon why it was unavailable. So in addition to this condo project management system that you as agents do not have access to, why, I don't know. There used to be a way that the public had access to this, but unfortunately, Fannie Mae has decided to restrict access to the public, which to me, I think is completely ridiculous. And it's actually one of the things that we're working on with our broker advocacy group, because wouldn't it be great if you as an agent could pull up the latest information on a particular building? Well, there's another thing that you as agents may or may not realize, but many lenders have an internal list of approved condos. So what that means is that maybe it never made it through the Fannie Mae process. Maybe nobody ever applied to have it submitted through the Fannie Mae process, but Rocket Mortgage, UWM, PRMG, whatever the lender is, has an internal list of condos that they've reviewed themselves, that at some point, one of the loan originators with them have either done a full condo questionnaire or a limited condo questionnaire. And we're going to talk about the difference between those two questionnaires in a second, but it has made it past the process. Now, it may not have made it with Fannie Mae, but it made it with PRMG or Rocket Mortgage or UWM or whoever it is, okay? You as agents don't see that, but we as a mortgage brokerage company are aware of that. So we have the capability to go to multiple lenders and cross-check, hey, has this condo ever made it through the process? And if it hasn't made it through the process, has it ever been rejected, and why, and when was that, and all of that. So there's a lot of really good internal information that we can get access to. So there are a lot of agents that think that if a borrower is putting down 25% that on a condo, that it's kind of a home run, or that it's easier. That is partially true, but not 100% true. So there's something called a full condo review versus a limited condo review. What's the difference? So we're still talking about conventional loans here, okay? We're not talking about FHA. We're not talking about VA. We're talking about conventional Fannie Mae, Freddie Mac loans. When it comes to putting down 25% on a primary residence or 30% on a second home or an investment property, the condo only is required we're only required a limited condo questionnaire. The difference between that and a full condo questionnaire is that on a limited condo questionnaire, it does not ask if there are reserves. It does not ask about the budget. It doesn't ask about the balance sheet. It doesn't ask about investor concentration or how many people are behind in their association dues. It also doesn't ask about certain things in reference to how many people are owning in that particular building. Like if there's more than one owner that owns more than a certain percentage of ownership, there's a lot of things that it doesn't get into. So it potentially, yes, could be easier. Now, what it does ask, which is also asked on a full review, is, are there any outstanding assessments? And if there are any outstanding assessments, what are they for? Is there any structural issues with the property? Is there any maintenance that's deferred with the property? So it still asks that set of questions that started in 2021 as a result of the whole Surfside situation. So let's just talk about condo financing in a full review for a second here. Okay, what does a full review mean? It means somebody could put down 3% on a condo. Now, or they could put down 5%. They basically can qualify for the maximum amount of financing available for a condo. Now, all of us know that there are many first-time home buyers, especially in Florida, that really need affordable housing, and most of that affordable housing are in condos. And unfortunately, there's a big amount of condos that have restrictions regarding down payments. And then there's also a lot of condos that won't accept FHA, that are not FHA approved. So then it leaves kind of this gray area. Okay. Now, let me preface all of this by saying, if a condo association has their own internal rule that a buyer has to put down 20%, 25%, whatever the case may be, that supersedes anything we're going to do with financing. So even if the association says yes to all of these questions on the full review, and it's a very strong association, and they pass everything with flying colors, and it looks like there's the ability for maximum financing, the association's approved, everything's wonderful, somebody could put down 3% if they're a first-time home buyer doing a conventional loan. If the association has their own internal laws or rules that the buyer has to put down a certain amount, unfortunately, the association makes the rules. So that's the first thing. But if they don't have their own internal laws or rules, and your borrower is trying to obtain maximum financing, there's a set of questions that we can provide you. And what we'll do is we'll send out those questions to everybody who's registered on this webinar. So you don't have to worry about sending me your email or anything. If you've registered for this webinar, we have it. And those are questions that are going to help you to weed out some of the problems on condo financing, such as, do they have reserves? Is there any pending litigation? There's a lot of questions that pertain to both a limited review and a full review. So let's just back up for 1 second, since we're focusing here on the maximum amount of financing and a full review. So condos who would qualify to allow a buyer to put down 3%. Okay. We actually have access to many internal lists from the lenders that we're licensed with of condos that have already made it through this process. So if you have a particular client who is about to either list their property or is looking in a certain area, reach out to us, reach out to one of our loan officers, and we can do a search for you of all condos in Miami Beach, or all condos in Port St. Lucie, or all condo, whatever city it is that have made it through this process. And we can say to you, hey, these are the buildings, or these are the names of the buildings that your client may be able to put down 3%. Or if it's a listing that you have in that building, we can give you some information as to the history of condo financing in that building, because we all know if you're able to sell the condo with financing, the chances are you can get a higher price for your client than if it's a cash offer on a condo. So let's just go back and talk a little bit about a limited review. So what is a limited review? A limited review is that shortened condo questionnaire. Like I said, we're not going to ask about the budget. We're not going to ask about reserves. We're not going to ask all those things. Okay. And multiple other things. Investor concentration, nobody cares about. This is a much more streamlined process. Now, what happens with a limited review, some questions are still asked. The questions about assessments. And then on top of that, regardless of the review, we also are going to ask if there's any outstanding litigation in the building. Now, if there is outstanding litigation in the building, it is not the end of the world. We need to find out what is the litigation and if the general liability insurance will cover it, or if we can get an attorney's letter explaining what it is. We've often done this in the past with the attorneys that represent the association, and we'll be able to tell whether we have a chance of getting it through or not. Sometimes if it's something that is clearly covered by the general liability insurance, or a simple thing, maybe it's a slip and fall, things like that, it's not the end of the world if there's litigation in the building. But the important thing is, and I cannot stress this enough, the important thing is that you are working with a loan officer who is thinking of these things and either making the phone call to the property management company in the beginning for you before your client goes under contract, or right in the beginning when they're in their inspection period, or we're in a position to tell you the information to ask, so that we're trying to find all of this out in the beginning. Because I think every one of us has either experienced this or been aware of somebody else that has gone through this, where a buyer gets all the way down to the end, and then the condo questionnaire is finally reviewed by an underwriter like a week before the closing, and then all of a sudden the buyer is not qualified. I mean, we get tons of people calling us a week before closing or 2 days before closing, or unfortunately really at the end of the process, can you help me save our loan? And sometimes it's just as simple as the client needed to change, the loan officer needed to change it from a Fannie Mae loan to a Freddie Mac loan, something simple. And so you would say to yourself, okay, why would something simple like that make such a difference? It's interesting because let's say there's an assessment in the building and it's for, I don't know, deferred maintenance. Like, for example, Hurricane Ian, there's a lot of condos on the west coast of Florida that are still going through repairs of the pool area or outside facilities or whatever they're doing. And it's not so much structural to the building itself, but it's deferred maintenance. That's something actually Fannie Mae wouldn't approve, but it's something that Freddie Mac would allow. It's just some small, simple thing like that makes a difference in helping somebody to be able to achieve what they're trying to achieve. So let's go back and talk about the problems that we see with regards to assessments and how we can really best deal with this. If there is an assessment outstanding, well, let's actually take it one step back even further. Like I said in the beginning, there's a lot of associations that are refusing to answer the condo questionnaire section about, are you aware of any structural issues? Are there any assessments outstanding that are structural, or are you aware of any deferred maintenance? Or sometimes the associations are just flat out refusing to answer it, or they just say, per our legal counsel, we can't comment on this, or whatever the case may be. If something like that happens, we have multiple lenders that will allow us to go back and get the last 12 months or 10 months of minutes from the association meetings to be able to build a case as to that there's nothing being discussed that is a structural problem or something that's a life-threatening problem. Now, if there is an assessment that truly has some type of structural thing associated with it, there's a few different routes that can be taken. One is getting a letter from the engineer for the building stating that it's structurally safe and these are cosmetic issues and that this is not something that is a concern for a safety concern. That's one avenue. And then the other avenue is doing a portfolio loan. So if a conventional loan is not possible, there are alternative lenders out there that their interest rates range anywhere from 0.75% to maybe 3% more than conventional rates, depending on the person's financial situation. But in general, there are lenders out there that are maybe about 1%. So if you're going with a conventional loan, more than likely these are borrowers that could document their income anyways. So they're probably going to be maybe about 0.75% to 1% higher on an interest rate. by doing a portfolio loan, but it allows them to be able to buy in that building. Generally, there's no prepayment penalty. If it's a primary residence, there's no prepayment penalty, and they can refinance the house once the work is completed in the building. So those are options that are available with portfolio lenders. So let's go back and talk a little bit about when you have a borrower that wants to put down less money, but you're trying to put in an offer on a building that does not have reserves, or you don't think it has reserves and you're not sure how to handle it. We actually have a program that allows a borrower, if the borrower qualifies, to put down 10%. It's a conventional loan, Fannie Mae rates. And what we do is we do a first mortgage for 75% of the sales price. And then we do a second mortgage for 15%. We do both of those loans. There's nothing that the borrower has to do differently. We coordinate it all. And the borrower will actually close with a first mortgage that's a Fannie Mae loan with no mortgage insurance and an equity line for 15% to make the total loans that they're getting 90% financing. And then they're putting down 10%. So there is a way that they can get into a condo as long as the association doesn't have different rules or different restrictions, but they can get into a condo with 10% down, even if the condo doesn't have reserves, and they can do it with a Fannie Mae loan as long as they qualify. And the good part of that is there's no mortgage insurance and there's no prepayment penalty. They get the benefit of the lower interest rates with Fannie Mae. We don't have to do a portfolio loan, and they can pay off the home equity line at any time. They can keep it open and continuously use it for up to 10 years. There's a 10-year draw period. It's a 30-year amortization. And so there's some pluses to that also as well. It also allows you to have financing go through smoother because now we're looking at a full condo questionnaire review. So let's talk a little bit about what's new and what's changing in reference to condos. I know that many of you have heard some of these changes from the state of Florida that happened shortly after Surfside. And there's a lot of big things that are coming down the pipe with condos. So currently, there are certain counties that have restrictions regarding inspections. Many agents that are on this webinar right now are in the Tri-County area. Some of you guys may be from out of the Tri-County area, but as many of you may or may not know, Broward and Dade counties require a 40-year inspection on a condo, and then subsequently every 10 years after that. Now, it's a structural inspection that's done by the county. This is something that will be asked when financing is started. Have they done their 40-year inspection? Have they done their 50-year or their 60-year or whatever the case may be, because it's every 10 years after that. Now, starting at the end of next year, the end of 2024, every condo in the state of Florida that is over 3 stories tall will be required to have inspections at 30 years. So even though Dade and Broward have their rules, what will happen is that the state rules will basically supersede that, and every condo will be required to have a 30-year inspection done. Now, if it's within 3 miles of the coastline, it's required at 25 years, but then there'll be a requirement every 10 years from there. Now, what's interesting as well is that buildings that are more than 3 stories, not 3 stories or less, but more than 3 stories, will also be required to have a reserve study for structural repairs. Now, what is a reserve study? And what does that mean to us? Does that mean that more condos are going to have the reserves required for Fannie Mae and that more condos are going to be approved in the long run? Maybe. The answer is maybe, because this is a study that is done by a third-party entity that says, hey, ABC Towers in Fort Lauderdale or whatever, wherever it is, in order for you to keep your building structurally sound, we think you need to have reserves of whatever that dollar amount is. Now, that doesn't necessarily mean that they're going to have 10% of their annual revenues in reserves, because that's what the requirements are for a condo to be able to get the maximum financing. For somebody to put down 3% or 5%, they're required to have 10% of their annual revenues in reserves. So we don't know yet how exactly that's going to play out with this new requirement, but the good news is that more condos will end up having reserves as a result of this. And we're kind of hoping that the guidelines will loosen up a little bit on the 10% requirement and maybe change to, as long as they have the structural reserves, that it should be sufficient. So we'll have to see. There's a lot of talk happening right now within the FHFA, which is the entity the government entity that oversees Fannie Mae and Freddie Mac, basically. So hopefully that will help us in the state of Florida, and that's going to be down the road that's going to be happening. So for now, what we are left with is, how could we best work within the guidelines that we have? And how can we best prepare our clients for the process? So we're just going to go over questions that you should ask as an agent, or you should have us ask to the association or whoever it is that you're working with for lending, which would hopefully be us, to speak to the property management company, or some of this is information that the seller may have. We're going to go over these questions now just to make sure that everybody understands them. And like I said, if you've registered for this webinar, we will send you a copy of these questions. So one thing I just want to mention before we go into these questions is there's a lot of misunderstanding in reference to FHA and condos, and why there's so few condos that are approved for FHA, because really 99% of the questions that FHA asks are the same that Fannie Mae asks in reference to a full condo questionnaire review. So you would think that since a good amount of condos make it through the full review process with Fannie Mae, that we should have more for FHA. Well, unfortunately, FHA has one small rule that Fannie Mae does not. And what that rule is if a buyer or a tenant has to be approved by the association, then it's considered a form of discrimination with FHA. And so what happens is that unless the building has already become FHA approved, which is, there isn't a lot out there, there are a few, and you can access them on the HUD website. So there are maybe a handful, but the chances of getting something FHA approved are very difficult, since most buildings require the buyer or a tenant, if they allow tenants, to be screened and approved by an association. So that's the biggest issue, and we're hoping that there's changes with that in reference to advocacy, because you would think that HUD would want to encourage making sure that the association is going to have homeowners or tenants that are financially responsible. Unfortunately, this is something that is going to take some time to change, but we're hoping that there'll be a change at some point. And I've been very involved with broker advocacy and trying to make a change, especially with our issues that we have with affordable home ownership in Florida. Is just, it's tough. It's tough. So how do we best prepare your clients for the process? Now, this is really important, okay? You as an agent must explain to your client that when they're buying a condo, even if it's a condo that you think's already approved, or even if it's a condo that the listing agent puts on the MLS that it's previously been approved, or even if it's a condo that your loan officer says it's approved, you must prepare them that there are certain things that have to be checked. And even with approved condos, there are things that have to be updated. So, for example, you could have a condo that's already fully approved, but we still have to make sure there's appropriate insurance on it, that there aren't any new lawsuits on it. So, as everyone knows, once you go under contract, your financing contingency runs concurrent with your inspection period, and everything starts at once. And so sometimes, or most of the time, we can't get all of these questions answered prior to you going under contract with your client, or your client going under contract to sell the house to a particular buyer. We try to weed out things that are quick, that we can find an answer on, like the reserves and all of these other things that may be, public knowledge, or maybe the seller has a copy of the budget and all this other things. But it's very important that that whoever is buying the property understands that there's going to be different things that have to be checked on the association, and they may end up paying for an appraisal and paying for an inspection and still not being 100% certain that the condo is approved, or there may be a problem with the insurance coverage on the condo that isn't discovered till later on. So you want to make sure you're having that conversation with them, as well as your lending partners having that conversation with them. I actually, many years ago, was aware of an agent that was sued by a buyer because she spent the money on the appraisal and the homeowner's inspection, and the buyer took the agent to small claims court because she claimed she wasn't told that there was a possibility that the condo wouldn't make it through the financing or approval process. So it's pretty important that you have that disclosure with your client. We have a standard disclosure that we use, but I would just put it in an email, making sure that your client understands that there are many things with condos that have to be checked when it comes to financing, and that some of those are not always able to be checked prior to them going under contract, that they need to have a discussion with their loan officer about this. And we will do all we can to try to weed out possible issues. So let's talk about these questions. First of all, the easiest question is, does the condo have 10% reserves? It's a simple thing. Do they have a copy of the budget? The listing agent normally will have the copy of the budget. If you're about to list a condo, please have a copy of the budget from the association ready, so that you're able to provide it to a potential buyer. And not only that, you can come to us and say, hey, I have a new listing. Here is the budget. What do you think? Do you think it would make it through? What does it look like? Now, remember what we said, if there isn't 10% of the annual budget in reserves, it doesn't necessarily mean that it can't get through. It just means that the financing may be a little bit different. It does not rule it out, but we have to prepare the client of either putting down 25% or potentially doing a combination of a first mortgage and an equity line. Now, the next question, the seller or may not know the answer of, and this may just be something that we need to find out on our own through either the association or doing some research on public records, but does the association have any pending litigation outstanding? A lot of associations won't answer some of these questions without us spending $300 on a condo questionnaire for them to answer 7 questions or 15 questions, or it's always the same questions, but this is a source of income for them, unfortunately. And so sometimes we may not have some of these answers initially up front, but we can do things like research the clerk of the court for the county that the property is located in, and try to do the best we can to see if we can find out if there's any pending litigation outstanding. And remember, if there is, it doesn't necessarily mean that it's not going to work. It just means that we have to find out more information on it. Some additional things that you can find out is, does the association have a requirement for a certain down payment. So even if Melinda and the Truth About Lending say that, you know, the clients can put down 3%, the association may have their own set of rules that require the buyer to put down a certain down payment. And not only that, they may also have their own set of rules in reference to a capital contribution. Is the buyer required to put a year of association dues with the association or pay some kind of additional fee on top of that? It's important to know this stuff up front, because even if you get through everything on the condo, if the buyer is short money to close because the buyer wasn't aware of this, that becomes an issue later on. So it's always important to ask these questions. Are there any special assessments outstanding? And if there are, what are they for? This is a really important question. And usually this is something that the seller has some kind of knowledge on. They received a letter from their association. They know they're paying for an assessment. They know they're paying a higher association fee because of a special assessment. So there's a good chance they have some kind of letter or can easily get something explaining what the special assessment is for. This is pretty important because we're going to be able to tell up front if there's going to be an issue. So we get back to the first part of my conversation with you guys, which is, if a seller is going to cover that special assessment, why does this even matter? Well, the fact that the building itself required an assessment needs to be disclosed to the lender, and it will be disclosed through either the condo questionnaire or even by the appraiser or by the title company. It's going to come up in one way or the other. We're going to find out about it. And what's going to happen is that the lender is going to want to know, is the work done? Or what was the work for? If the work was for maintenance or something like that, it may not be a big deal. But if it's a structural issue, or if you hear the words concrete restoration, which seems to be like the dirty word in condo financing these days, that scares a lot of lenders, then it changes the kind of financing that the borrower has to get. Remember, it doesn't mean that the borrower can't get financing. It just means that they may be able to get financing as a portfolio loan instead, meaning that Bank of America, Chase, Rocket Mortgage, the typical A-paper lenders are not going to do this loan. But there are other smaller banks that may consider doing it at a slightly higher interest rate. So these are things to think about when you're looking at condo financing. Now, there are some other questions in reference to the insurance that you guys are not going to want to get into, but if you can either get us the phone number for the association or get us the phone number for the master insurance for the association, we'll take it from there. Generally speaking, just the property manager's number is fine. We'll call the property manager. We'll ask for proof of insurance. Now, there's a lot of things that can come up from the insurance, like co-insurance, or if they have a fidelity bond, whether or not they have sufficient coverage. There's a lot of other things that we're really not going to get into for the purpose of this call. There are ways around some of these things, and some of these things there's a hard stop to. So we know the answers to these questions, and we know when there's a potential problem, but wouldn't you like to know this as early as possible in the process, possibly even before you put an offer if we can, or during your inspection period, or something where we try to get you an answer as quick as possible in the beginning? Obviously, we're not going to be able to get you 100% of all of the answers, but we're going to do as much as we can up front to potentially protect you and your clients. Now, there's a few other things regarding the questions that you need to ask. You know, if it's an older building, then you're going to ask about the inspections. If it's Broward or Dade, if there's a 40-year inspection, 50-year, 60-year, every 10-year inspection that's going to be done. But remember, starting the end of next year, if it's a 30-year-old building, you're going to be asking if there's a 30-year inspection. So that's some of the questions you can ask, but let's just take a moment and talk a little bit about some other issues that come up with condos in Florida. Condo hotels and rec leases. What are they and why are they so difficult? Well, condo hotels are basically condos that are operating as hotels. Many of you already know this or have seen this or have experienced this or maybe hearing this for the first time. But basically, there is a hotel type of feel to the building. There's a front desk, there's a check-in, there's maid service, there's hotel-like qualities. These are typically buildings that maybe even were a hotel at one point and were converted to condo hotels. These could be very small, one-room or two-room spaces that has a kitchenette in them or other things. These type of condos do not qualify for any type of normal, regular A-paper lending, meaning they don't qualify for Fannie Mae, Freddie Mac, conventional, VA, FHA, any type of normal A-paper lending. They do qualify, however, for portfolio lending. So there are lenders that will do this. The down payment is usually a higher down payment, so typically 30, 35%, maybe possibly 25% in some situations, but really a higher down payment. There is financing available for these type of properties. Then let's talk about recreational leases or rec leases. This is a pretty important thing. If you see this on a listing where it says it's a rec lease or recreational lease, what does that mean and how can you work within it? A recreational lease means that the building that the condo, that the homeowners association, the condo association, the members that are living there of the condo association, the homeowners in that complex do not own the recreational facilities. They don't own the clubhouse, they don't own the pool, they don't own the tennis courts, whatever recreational facilities that are offered in that condo complex are not owned by the homeowners or by the condo association. This type of setup is very common in many 55 and over communities like Century Village. And this is something, again, that does not qualify for regular A-paper normal financing, but there is alternative portfolio financing available. So it's very important that you always ask upfront, is there anything like a rec lease in this building? And there, it is not as common when it's not a 55 and over building, but it is still something you'll see from time to time. So that basically is most of the presentation. If anybody has any questions in reference to any of the points that we touched on, as I said, we are going to send the list of questions to the people who have registered for the webinar, as well as a copy of the video, so that if you want to play back and listen to it, that you can. The most important thing that to get out of this webinar is that there are options for people who want to buy a condo with financing. It's important to understand the process and for us to do all we can to be able to protect the clients and to be able to assist them to get through this process. Now, one thing I do want to mention is that we are going to be launching a condo help desk very soon. You'll see an announcement from us shortly, in a few weeks or less coming on that, basically where you will be able to log into our website and enter a property address. And then one of our associates will call you back and let you know all the information that we found out on that condo, and tell you if this is something that's viable or if we have any knowledge of what is going on in that condo building. Okay, we have a question here. Somebody has sent me a question regarding What if there's still work being done on the condo? Does that disqualify it from financing? So the answer is not necessarily. There may be some type of financing that is still available through conventional normal financing. It depends on the work. And if it is something that is deemed unacceptable for conventional financing, then there are portfolio lenders that may be okay with it. We have another question here regarding no income verification loans or alternative income verification loans in condos. So the alternative or portfolio lenders each have their own requirements for condos. So if you're doing a no income verification loan or an investor cash flow loan or a bank statement loan or something where it's alternative income, we will know what lenders are okay with no reserves, low reserves, whatever the case may be. But it's really a very specific list of requirements for each portfolio lender. So some lenders, some no income verification lenders follow the Fannie Mae guidelines and are looking for the whole shebang, pretty much looking for it to, pass everything. They're just doing a no income verification loan. And then there are some portfolio lenders that have no condo questionnaire at all, and they just ask 5 questions. So there's the entire gamut of everything in between. The important thing is that we are weeding out any potential problems up front as much as we possibly can, and at least giving you the ammunition to be able to ask the right questions and to best guide your seller or buyer. Because if you have a listing that you have taken for a condo, you want to know, can you accept financing in there or not? And we will be able to guide you and explain to you, yes, you can accept financing, but here's the limitations, or no, there's a problem in there, or yes, you can accept financing, but it needs to be with a portfolio lender, whatever the case may be. So that way you are saving your seller the time and protecting them as much as you possibly can through the process. So I think that's going to wrap it up for today, unless we have any other questions regarding anything that we have discussed. If anybody else has any other questions, now would be the time to chime in. I don't see any other questions, so I'm going to wrap it up. I do want to tell you we are going to be talking next week about down payment assistance programs, the good, the bad, and the ugly, because there's a lot to understand with these down payment assistance programs. And if you'd like to join us next week for that webinar, please make sure you register. As always, if you can't make it to a particular week, if you register, we will send you the YouTube video of the webinar. You can watch it whenever you want. So if you want to look at our Lunch and Learn calendar, you should be able to see the topics for the rest of the year. And please register. And at the very least, if you're not able to make it, we will certainly send you the YouTube video. Thank you again, everybody who's attended. And I hope that this has been a very informative session on condos in Florida. And hope everybody has a wonderful week, what's left of it, and have a great day, everyone. Bye.